Welcome to the AI Brief from the YPO Technology Network. I'm Stephen Forte. Earnings week just did something to artificial intelligence that it had never quite done before. It stopped grading the story and started grading the arithmetic. On today's episode, a record-setting reward and a same-night punishment for the exact same behavior, an insurance broker who published the number nobody publishes, a power utility that quietly marked the AI boom down by 40%, and a correction to something I told you last Monday. Here's the promise for the next few minutes. By the end, you will know what the market started charging for AI spending this week, and the 4 blanks your own largest AI program should be able to fill in before your board fills them in for you. Start with Wednesday night. Microsoft and Meta reported earnings within an hour of each other. Both are spending historic amounts of money on AI. Both grew revenue by more than most companies in your portfolio will grow this decade. And they got opposite receipts. Microsoft's cloud business, Azure, grew 43% and crossed $100 billion in annualized revenue. 30 million people now pay for Copilot seats inside Microsoft 365, up 50% in a single quarter. But the number that did the work was duller than either of those. Remaining performance obligations, that is the accounting term for revenue already under signed contract but not yet delivered, hit $678 billion, up 84% in a year. The market's response was to add more than $400 billion to Microsoft's value in a single day, one of the largest one-day gains in stock market history for any company ever. Meta, the same night, beat its revenue estimate, 28% growth, and the stock fell almost 10% after hours anyway because the other numbers told a different story. Capital spending guidance raised to as much as $145 billion and free cash flow, the money actually left over after the bills and the building, down 91% to $784 million. Meta's quarterly dividend is now larger than its quarterly free cash flow. Read that sentence at board pace. The company is paying shareholders more than the business currently throws off to reassure them about the money it is spending. Same night, same technology, opposite receipts. Here is the lens for everything that follows. The market stopped grading the sentence, "We are investing heavily in AI," when started grading the receivable behind it. Friday's episode was about the ruler you use inside your company. This week, the outside world picked up its own. Now, you might be tempted to read Wednesday night as the market souring on AI spending. Thursday killed that theory. Amazon raised its 2026 capital spending to roughly $220 billion, a $20 billion increase, and the stock went up, which tells you the market is not afraid of the number. It is afraid of the number arriving without a customer list. Amazon Web Services grew 36.7%, its fastest in 18 quarters, against a $496 billion contracted backlog. And Andy Jassy talked about the spending the way a utility finance chief talks about a power plant. The capital goes in 2 years before the servers do. The servers take a little under 3 years to break even, and most of the AI capacity is already contracted on terms of at least 5 years, with 2027 largely reserved. The most futuristic company on the call sounded like a gas utility. That is precisely why it was rewarded. There was even a tell inside Meta's own call. Mark Zuckerberg mentioned mid-punishment that Meta keeps getting offers to buy its spare computing capacity at, his words, a significant premium over what they paid for it. Even the company being graded on conviction is quietly reaching for a receivable. And Apple ran the control experiment. It gave no AI capital spending figure at all, deliberately. Tim Cook said only that they are spending quite a bit more spread across ordinary operating costs. Outside analysts put Apple's entire capital budget near $13 billion against the $700 billion the big 4 cloud builders have guided to this year. The stock fell anyway on soft guidance and supply constraints. There is no spending level high or low or undisclosed that protects you from arithmetic. Now, here is where this reaches your company, because the most radical disclosure of the week did not come from a technology company at all. Willis Towers Watson, one of the world's largest insurance brokers and advisory firms, the kind of business most of you buy services from, not chips, used its Thursday earnings call to announce an AI program called Propel. And then it did something almost nobody has done on an earnings call. It published the ratio. Roughly $625 million invested to capture roughly $400 million in annual run rate savings. $350 million net after reinvestment, a cash cost to achieve of 1.6 times, a dated operating margin target of about 30% by 2028. The texture underneath is what makes it believable. An insurance processing task that took 4 hours now takes about 5 minutes, and headcount is being managed by attrition, rehiring 9 of every 10 people who leave, not by layoffs. The same day, a company called CCC, the software firm that processes a large share of North American auto insurance claims, disclosed more than $120 million of annualized revenue from its AI products, about 11% of its total, growing at roughly 45%. An AI revenue line on the income statement at a mid-cap. One broker publishing a cost ratio is a curiosity. But the same week, a Medicare Advantage insurer, that is the private version of the U.S. government health plan for seniors, raised its guidance and credited an AI model that predicts which 10% of its members will drive 70% of hospital admissions. An XPO, one of the largest trucking operators in North America, said AI workforce planning and a camera pilot that cut trailer damage in half helped it absorb a $46 million wage increase. This is what a disclosure standard looks like while it is escaping the technology industry. Even the power grid joined the grading this week. Exelon, one of the largest utility operators in the United States, told investors its high probability pipeline of AI data center demand fell from 18 gigawatts to 11 in a single quarter. Why? Because Exelon started requiring collateral before it counts a project as real. Its finance chief said it plainly: we now weed out speculative projects. Nearly half the boom, marked down by one signature requirement. And the projects that survived the filter look like the news from Southern Company, the utility serving much of the U.S. Southeast, the day before. A 3.2 gigawatt, 25-year power contract with OpenAI. Paper survives, stories evaporate. Here is my read. The market did not learn to hate AI spending this week. It learned to price it. AI CapEx now trades like any other capital program, like the way your bank treats a loan application. The business plan is nice. The signed purchase orders move the rate. And once the market prices something, boards adopt the rubric within a quarter or two, because board members sit on more than one board. The audit chair of a 300 million euro distributor in Rotterdam heard WTW's ratio this week while sitting on someone else's board. That is how a disclosure standard travels, not through consultants, through calendars. So if I were sitting in your seat this quarter, I would do one thing. Take your largest AI program and fill in WTW's 4 blanks before someone fills them in for you. Cost to achieve, run rate savings, net after reinvestment, a dated target. If your program cannot fill in those blanks yet, that is not a failure. That is the finding, and it is far better discovered in your conference room than in your valuation. Before the close, one correction, because we owe you those. Last Monday, I told you that on pricing algorithms, the defendants were winning in court. The Las Vegas casino hotel case had been dismissed and upheld on appeal, and so the action had moved to legislatures. That red aged badly and quickly. On Wednesday, a federal appeals court on the East Coast, the Third Circuit, one of the regional courts one step below the U.S. Supreme Court, revived the Atlantic City version of the same case against Caesars and MGM, ruling that hotels allegedly coordinating room rates through a shared pricing algorithm can be sued for collusion after all. 2 appeals courts now disagree, which in the American system is exactly how a question ends up at the Supreme Court. If your company uses shared or vendor-supplied pricing software wherever you are listening because U.S. antitrust theory travels, the safe assumption is no longer that the courts have settled this. It is a jump ball. We tell you when our read changes. That one changed in 5 days. One thing to watch tonight, Palantir, the data and AI software company best known for its government work, reports after U.S. markets close, hours after this episode reaches you. It will be the first pure play AI name graded under the new rubric. And watch for the second company in your own industry to publish a Propel-style ratio. The first one is a curiosity. The second one sets the benchmark. The third one gets asked why theirs is worse, because that is the structural truth underneath this whole week. Nobody coordinated this. A stock market two utilities, an insurance broker, and a claims processor all reached for the same ruler within 48 hours of each other. New eras do not announce themselves with a keynote. They announce themselves with a spreadsheet column. The market stopped grading the sentence and started grading the receivable. That is the YPO Tech Network AI brief for Monday, August 3rd. I am Stephen Forte. If this was useful, send it to a fellow member. I will be back tomorrow with more. Until then, stay sharp.